Deepak Shenoy joining now. He's founder and CEO of Capital Mind. Deepak, great to have you on the show. As always, hope you've been doing well. So much to unpack and discuss. Should we start with what you make of Electra Green Tech, since that was a story we were just discussing before we came to you?
Hi, Tamanna. Thanks so much. I mean, given that I'm in a mutual fund role right now, so it wouldn't be right for me to discuss individual stocks. So, and I haven't seen this
Okay, where's the fun in that, Deepak? No. But okay, on a more serious note, we have to talk about, what kind of a turning point we see from the RBI's announcements. I mean, it's good enough to say, all right, front-loaded bazooka on liquidity, CRR cut 100 basis points. You've seen a 50 basis point cut instead of a 25 basis point. But then a view also coming in that there'll be a pause in August. Are you subscribing to that? And is it fundamentally shifting your view on BFSI?
No, I honestly feel here that the RBI has perhaps given a signal too early because it feels that inflation will start to come back in the next year. My feeling over here is that a lot of our inflation is largely related to agricultural related issues and concerns. And I think one of the given that that's the input, then yeah, maybe, because you can't control that much that meaningfully. But if there is a recession in the world in terms of trade, in terms of other aspects, you're going to see benign demand across the world. And if the inflation does fall all around the world and interest rates across the world also start to come down by next year, this will not be the bottom. It wasn't even the bottom. In fact, we were at lower rates in 2019, even before COVID. So when there is a stretch of bad growth and low inflation, you are going to see the government want to reduce its, the RBI want to reduce its rates to promote growth. Why would we have a 3.7% inflation, which is what is predicted for this year, and 5.5% rates, 1.8% real rates? I mean, that is very unnecessary, to be honest. And I would say, I think they have called it a little bit too early. And I believe it's only a hedge against geopolitical issues cropping up or any of the other stuff that coming in. But once growth slows down, if it does, then I think the rates will go even further lower. And I think we should not get more than 1% real rates. In fact, we've been negative real rates for more than half of the last 20 years. So I think, getting real rates to close to zero is not a problem in a country that needs to encourage growth. Credit growth has just not happened in the last 4 or 5 years now.
Okay, so Deepak, good afternoon, Neeraj here. It's been a while, so good talking to you. I wonder if this sets the stage for a sustained move. I mean, the expectation, I would presume one of the things that the RBI may have done this also, get some animal spirits in and then hope that the multiplier effect takes shape. You reckon that can happen and there can be a sustained move? Because a pop, one can argue, anticipated has happened and that's done. What next now from a shareholder's perspective?
Yeah, to be fair, I think banks need to start thinking a little bit more about volumes and a little bit less about margins. They're all intent on protecting their NIMs. Why do we have banks with 4% NIMs? It's nonsense. We should not have 4% NIMs. We should have much lower NIMs. And in general, if you consider the fact that growth is more important to a society and a bank also in that sense than anything else, a bank growing at 10 to 12% is not going to get that valuation, regardless of whether it has high NIMs or not. And we live in dreamland when we try to think that we'll keep getting 4% NIMs forever. Look at any Western economy, developed economy. You're not getting those 4% NIMs anyways, even though they have far lower regulatory requirements in terms of CRR or SLR and all that stuff. Their NIMs are considerably lower. They have had their animal spirits moments at some point in the middle, and they gave up NIMs to actually go lend, and I think this actually go lend has a lot of legs, but to a certain extent where the RBI also doesn't like sudden spurts of growth. So you suddenly start to lend to retail and RBI says, no, clamp that down, it's growing too fast. Then you start lending to corporate and then they say, so there is a regulatory fight over here within at some point where RBI says, well, grow credit growth, but don't grow too fast. There will be pockets of very high growth, I think. And RBI, in its nature, feels like it has to curb a lot of these elements. But I think we should at some point see this changing. The stance has changed in the last 1 year in terms of allowing more great good things to happen. And even now, I think as the regulations seem to be coming, we should see more. The problem right now has been that corporate credit has not grown meaningfully from 2014 or 2015. And since the IBC Act came to, kind of restrict corporate bankruptcies and what happens when they actually can't return the money, even corporates are a little more afraid to lend. But that doesn't mean that we will continue to get this. I think the corporate shift should happen, and they should take over some of the space that's left over by retail. Now, whether that happens in the next 1 year, I think if banks reduce their NIMs at least to SME lending, there will be growth in that area as well.
Okay. Okay. Now, Deepak, the other aspect therefore will be, will other rate sensitives benefit dramatically from this? Or is it the market believing that they will? Because we've rewarded real estate, for example, not as much autos maybe, but I thought that autos would be the first port of call per se. I don't think people buy real estate because rates have gone down by 50 basis points, but I may be wrong, right? So I'm asking your view. What do you reckon are the others which benefit with this 50, 75 basis point cut and the liquidity arrangement that the Reserve Bank has done?
So I know the biggest benefit is to larger corporates who borrow through the bond market. And I think they've seen that benefit happen already. We've seen short-term rates come down quite considerably to the point where any operating company that works in the markets, if they come to and do a bond issue and they're reasonably well rated, you will have all mutual funds, all insurance companies, everybody else salivating over trying to lend them money because there's such a shortage of good issuers in the bond market, which are not NBFCs. I think that should go, trigger a lot of action over there. More of the small and mid caps should also go down into the bond markets to try and borrow, at least for their working capital needs and some for their long-term needs as well. This is very important for India as a growth story as well, because all developed markets, corporates borrow from bond markets, small, medium enterprises and retail borrow from banks. That's how we should look at it from a growth perspective. Then, of course, the small and medium manufacturing companies that need working capital will benefit from using the bond market to issue their debt. The downstream impact of what retail buys using this, so whether it is consumer loans such as housing loans or loans against property or loans against small business and all that, I think those are the ones that have a downstream benefit. Unfortunately, banks tend to keep those spreads very high. Housing loans are the cheapest because they get the best regulatory treatment. But you take the same house and put it as a collateral against you money that you want to borrow to set up a business, your rate suddenly goes up by nearly 3 or 4%. So what is 8% in a housing loan or 8.5% in a housing loan is 12.5% on a loan against property minimum. Something that goes to 18%. So there's a very wide spread between what people pay at one level versus people pay for something that is just slightly different, including loans against securities, loans against gold, and so on. So this difference, this wide spread between these loans means that the incremental benefit of a small interest rate change of 0.5% helps the retail borrower in real estate a lot more. 8.5 coming down to 8 is a big benefit. But 18% coming down to 17.5, not so much, right? So you're going to have to see not just a contraction in rates, but also a contraction in NIMs in order for some of these companies to do better and to actually see growth from this thing side. So I would say at this point, the beneficiaries largely will be NBFCs, will be corporates that are borrowing from the bond market. But unless these, the banking system and the non-banking system are able to bring down effective rates across the board beyond housing, I think we are not going to see a meaningful change in credit growth.
Okay, so just on another, what caught my notice is something that you tweeted out on this, Deepak, is this whole rare earth crisis, and we always love chatting with you on everything under the sun. So, just was interested to know your view on this. Is this an opportunity? Are there spaces? Because the street right now is looking for opportunities.
Well, I mean, let's put it this way. I think that tweet was more in the context of India's sovereign security
Yeah.
more than it was about profitability. Because if you look at some of these things in rare earths, there are light rare earths, heavy rare earths. India, in general, overall rare earths has about, I think, the third largest. So we're very far behind what China does or what some of the other, somebody else, I think Vietnam or somebody else has in terms of rare earth reserves. But our reserves are enough for us to make rare earth magnets for another 400 years, even considering growth. So I don't think there is a problem in understanding that we need to be able to access our reserves. The problem is in the reserves or the mining, it's the processing. These things are extremely expensive things to set up, and the yield on an incremental basis is low, so you get a low return on that initial investment, but subsequently after the initial investment you have very little regular costs to pay. So your ROE on the incremental return after you set up this plant and all that stuff is much higher. Now, what China does is actually subsidizes these initial development, and it says, okay, well, you know what, let's go in and build this stuff because we need it. So we'll make sure you get money to do this. And then after a while, you please handle your own operating expenses. So it reduces increases the effective ROE for me as a business to be able to say, listen, my initial cost is taken off. Now I can produce here. And then those rare earths then become usable sources for the military, for even the fact that today we have to beg China to please allow us to pay them for those rare earth magnets that we need to use in our cars, motors, and sensors, and so on. And I think that is a sovereign security problem more than anything else.
I mean,
So we should.
but the only, I think, upside to that is that the world is facing it. It's not just India. Everyone was sort of sleeping on this problem.
Who's to say, Tamana, tomorrow that they refuse only us and not and give the
Yeah.
rest of the world?
Yeah.
No, I'm just saying that that's a problem.
That is a problem. No, so just a couple of things more, Deepak, and one thing that has been on top of mind, a big mover in the markets right now, all of these block deals. Some of them promoter stake sales as well. And the typical way of looking at promoter stake sales is not very positive, right? You have that point of view of, oh, are the promoters cashing out at the peak? Are they seeing something that investors are not? If promoters are cashing out, should you come in? But something quite the reverse is happening in the market right now. Promoter stake sales getting lapped up and by marquee investors. How are you looking at it? Are you looking at these as opportunities?
Yeah, many of them are. I mean, in some cases they have to be because the government, the promoters own more than 75%, and they have to sell something to just allow things to be bought. But another thing that happens is if your free float is already kind of taken over by everybody who already wants to buy the stock, how else does somebody else acquire a large, reasonable block of shares? And then, therefore, your company becomes uninvestable simply because you don't have enough shares that are out there in the market for them to be able to purchase. And even a small amount, like a $50 million investment, will spike up the price by 10 or 15%. This is a traditional problem in India forever. You talk to brokers, they will tell you that this is their means of differentiation, is that if you talk to me, if you go directly to the market, you will not be able to buy this much shares. Come to me and I'll find you the buyers and I'll arrange blocks for you and all that stuff. Now, if you had to do this for something as small as $50 million, the worldwide investors are looking at us as like, listen, this is too small a market for us to even think about. You need more free float in the market for this market to be really a market. And if 50 to 75% of your stake is cornered by largely, the promoters themselves, cornered means they're owned by promoters who don't want to sell, you have a problem. So I think bringing that down is a good thing in a lot of cases where promoters have on 75%, which is the maximum permissible, down to maybe 60, 50%, keeping 50% as your minimum. I think that is fine and fair. In other cases, in some promoter cases, we've seen where promoters have kind of had a tiff with each other and they've moved on and then they are now selling their shares, but they're still called promoters because SEBI does not easily allow the definition to be changed. So over a period of time, you're going to see these next generation entrepreneurs, or even the same generation where there have been multiple entrepreneurs who've parted ways, anyway sell. We've seen some of the largest stake sales from promoters have happened like this. In other cases, it was foreign companies that owned 75% from a legacy of the 1970s, where they were forced to be listed and the maximum they could own was 75%. So they keep 75%. And now they're thinking, why do we have 75% in a market that A, wants us, and B, our home markets don't price us at the same PE as these markets.
So that could be one way. That depends, right? From company to company. That could be one way of looking at it. The others are that they're making hay while the sun shines. So is the sun going to shine any longer? But I suppose you should make a case-by-case assessment.
I think, honestly, promoter buying is a bigger indicator of anything than promoter selling.
Which is a positive indicator, is it?
Usually more positive than the selling is negative.
Yeah. Oh, yeah. Fair enough. Because you're backing your. So before we wrap, Deepak, since you started by talking about your responsibilities as in the mutual fund space and managing public money, how difficult is it for you right now to find pockets of value for those who have entrusted you from where markets are right now? What is your outlook there?
So I think my short answer is I'm not looking for pockets of value. I'm looking at pockets of growth, which means what you will not call me a value buyer at any point, but you will definitely call us buyers of growth, because we like companies that are growing. We like spaces that are growing. And in some cases, if a premium has to be paid today to be able to acquire some of them, we'll pay it. We've done this in the past, and what was ridiculously expensive even during COVID has now become 10 times or 15, in fact, now 17 or 18 times it has grown in the last 10 years. It's still ridiculously expensive. But, when you get a few instances of that because of the growth story, because of the kind of, changes that are happening on the ground, that as they bear fruit, some of these companies will grow. I don't mind paying for growth. So I'm not traditional value, but I think if growth is much bigger than the price premium that you're paying for it, then it's okay. I think those pockets are still available today, whether it's defense, whether it's manufacturing, domestic consumption, the financialization part of the economy, or even in some cases infrastructure. I think we're in a growth story that will probably last us the next decade.
Thank you so much, Deepak, for speaking with us. Growth story that will last us the next decade. Those are the picks that Deepak is looking at. Won't tell us his picks anymore because with his mutual fund hat, he can't really do that.